Welcome back to The Explainer. Today, we're going to solve a puzzle that trips up even the most experienced investors. What actually happens to a company's profits? And more importantly, what does it all mean for the money in your pocket? So picture this. You see a headline. A company just posted record blowout profits. But then you check its stock price and nothing. It's flat. Maybe it even went down a little bit. If that's ever left you scratching your head, trust me, you are not alone.
You see, the answer to that little puzzle isn't hiding in the daily stock price. It's all about understanding the two main ways a company can reward its owners. That's you, the shareholder.
Okay, so when a company is doing well and finds itself with a big pile of extra cash, it faces this really fundamental choice. It's a good problem to have, for sure, but they have to decide, what do we do with all this money?
They're basically standing at a fork in the road. Path 1, they can plow that money right back into the business to fuel future growth. Build new factories, buy another company, pay off some debt. Or path 2, they can return it directly to the shareholders. And today, we're going to walk down that second path. All right, let's start with the most direct, most classic way a company can hand cash back to its owners: paying a dividend. A dividend is, well, it's pretty much exactly what it sounds like. The company literally takes a chunk of its profits and sends it to you. It's your share of the profits, deposited right into your brokerage account. Think of it as a direct reward for being an owner. To really see how this works, let's use a quick example. Meet the Awesome Widget Co. Things are going great, its stock is trading at $50 a share, and it has an extra $10,000 in cash just sitting on its books. So the board gets together and decides, hey, let's pay out $1 in cash for every single share out there. So if you own one share, you get $1. Simple enough, right? But here is the absolutely crucial part. That $1 had to come from somewhere. It left the company's bank account. So, because the company is now worth $1 less per share, the stock price should, in theory, drop by that exact amount. The key is you haven't lost anything. That dollar of value simply moved from the company's pocket to your pocket. But that's not the only trick up their sleeve. There's another, more indirect way for companies to send value back to you, and it has become incredibly popular. We're talking about share buybacks. So instead of sending cash to every single shareholder, the company uses its pile of cash to go into the stock market and buy its own stock. And then those shares are basically retired. Poof, they're gone. This reduces the total number of shares out there in the world. Okay, let's hit the reset button on our example. Back to the Awesome Widget Co. Let's say you own 10 shares. Since there are 1,000 total shares out there, your 10 shares mean you own exactly 1% of the entire company. Think of the whole company as a giant pie. That pie is cut into 1,000 equal slices, or shares. Right now, you own 10 of those slices. That's your 1% of the pie. Now the company takes some of that cash we talked about, goes out and buys back 200 of those 1,000 slices from other people. Those 200 shares are then removed from the market. So look what just happened to the pie. The total number of slices just shrank from 1,000 down to 800. But you still have your same 10 slices. But because the whole pie got smaller, your piece is now a bigger part of the company. Your ownership stake just jumped from 1% to 1.25%, and you didn't have to do a thing. The stock price didn't change, but your shares are now more valuable because each one represents a bigger claim on the company's future profits. The value was returned by making your existing shares more powerful. All right, let's pull all of this together and finally solve that puzzle from the beginning. How do we account for these different ways that a company returns value to us? The answer is a concept called total return. Honestly, this is the one number you have to understand to know how your investment is really doing, because it captures the whole story, not just what the stock price did. So let's rewind to our dividend example. If you were only looking at the stock price, you'd see it go from $50 down to $49. And you'd probably think, hey, I just lost $1. But of course, that's ignoring the other half of the story. You're forgetting about that $1 in cold hard cash that the company just deposited right into your account. So you take the $1 price drop and you add the $1 dividend you received. What's the result? Zero. Your total return was zero. No value was lost. It just moved from one place to another. And that is the solution to our puzzle. A company can have record profits, give them to you as a dividend, and the stock price might fall, but your actual net worth as an investor stays the same.
So now that you get the mechanics behind all this, what should you actually be looking for when you're analyzing a company?
Here's a quick mental checklist. The next time you see a company's earnings report, don't just look at the stock price. Ask these questions. Is it paying a dividend? Is it buying back shares? How much is it giving back versus how much is it putting back into the business? It's not that one is better than the other, but the answer tells you a ton about their strategy and their priorities.
And that all leads to the final, really crucial question you have to ask yourself. Do you want a company that gives you cash back right now, or one that reinvests every single penny for what could be much bigger growth down the road? There's no single right answer, but now you know how to look beyond just the stock price to find it. Next time, we're going to zoom out from individual companies to see how we measure the health of the entire economy.